Welcome everyone. I made a video about Voxtur Q2 numbers are out, and about 4 hours ago we got this comment from David Bradford. We need to hear from Colin, so we cannot disappoint David. So Colin, we cannot disappoint. Thank you for joining me.
I thought it'd be more disappointing to hear from me, but yeah, sure. Good to be here.
Okay, I think you had some time to look at the financials for Q2 for Voxtur. I think you had some time to digest the information. So let's hear what your thoughts are.
Well, I think you covered a bunch of it. I think well in your piece. Revenues have begun to grow again, which is nice. Gross margins are expanding, which is nice, which gives us gross profit, which is close to all-time highs at this point. So it looks like they're getting costs in order. I will still say though there are, and the EBITDA element saying that it's plus $500,000. The problem with some of the elements that are moving around on these things like EBITDA is that EBITDA, I think, there's like $4 million of other elements in when they calculate, get rid of all the different non-cash items and whatnot, that really does a lot of the heavy lifting of the EBITDA. So so cash flow from operations, I think, is a good one. So there it is. Costs related to non-operating items, non-recurring items, and or strategic initiatives. That's $4,094,000, and that's in Q1 that same number did $2 million of heavy lifting, and it's there quite frequently. And so I'm not a huge EBITDA. I'm starting to dislike their EBITDA more and more. Share-based expenses is another big element. It's fairly consistently high, and I think it will remain fairly consistently high. So at some point, some of these EBITDA numbers are they're just too many costs, like things like amortization of intangible assets. Sure, I think that's a reasonable one to get rid of. Share-based compensation, fair enough if you're looking from a cash flow element, but the cash flow from operations, I think, is a more telling thing than to use EBITDA as a cash flow from operations. Cash flow from operations and EBITDA start becoming more meaningful when they're at least within the ballpark of each other. So CFO is like negative $2 million or whatever it was. And so, I look at that and go, yeah, that probably is a better indicator now for cash flows, at least from operations, as it says. Where I think some of the, I've said it before, I'll say it again, I think they should start to report in US dollars. Most of their money is in US dollars. If you look back at it to the adjusted EBITDA numbers, foreign exchange gain through profit and loss in January 2022, it was negative. It was $2,700,000 to the negative. In this quarter, it was $2,700,000 to the positive. These non-related operating stuff, that like EBITDA really is, to me, starting to slip. I'm not liking this as much when you're starting getting these quote unquote non-recurring items, and the number does a lot of the heavy lifting. So to me, the EBITDA number is, starting to discount it. I think, unfortunately, you have to start really parsing into it and looking at the CFO. Comprehensive income and losses. The comprehensive loss is, when you look at that, $7 million of it. Of the 10.4 million loss is from currency exchange, right? I mean, when you get these big, massive fluctuations that are just like this. This is a company that has a lot of noise, and they should just simplify some of these things and just move to a U.S. based currency. Because I think 80-90% of the revenues now are US, and so you just add noise for no good reason, in my opinion. Change in tax recovery was $2.6 million. So comprehensive loss. If I got around to it, I would build a model that would just move everything to US, and I bet you there's a lot less noise with that. But it's just more work than I really feel like doing. But, so I think that, writ large, the company is doing okay. The noise in the thing is getting bigger. Like I'm not really a big fan of an EBITDA number where there's $4 million of it is to some black box of stuff that seems to be they're fairly consistent. So, and the other thing is then I was looking down at the JEA element, where they are, so the service agreements, in the one of the things you can start to see is because they haven't broken out the revenue numbers by unit and by business segment. You lose a lot of information in the company, and so here it is. Revenues for 3 and 6 months now with the new arrangements that started at the beginning. So revenues for 3 months was nil. 6 months was $956,000. The expenses were nil and $591. The way they've broken it out, though, is you don't know, so the expenses that they have is for premises, equipment, furniture, and improvement, as well as sub-licensing of software by the company from JEA Group. And so part of that revenue that we're receiving from JEA is, I think, on the foreclosure business and maybe some settlement business. So that gave us almost $1 million. The expenses, though, were $591, which gives you a gross profit of 38. But there's so much stuff in there, like in when you talk about premises, equipment, furniture, and improvements, so it's really noisy. It'd be, I think the biggest move that this company can do is to really start to parse out their business units, because at some point in time, you're just really having problems understanding what the business lines are doing. So, we can see now, at least they parse out that element. This is a line. We know that they made $1 million a quarter. That dropped, from, I think, the year previous, $7 million or something. Yeah. So the 3 and 6 months from 2022 was 3.7 or 3.679 and 7.3. So, that revenue line is a big part of it, but that was not great revenue in terms of it. It was low margin. We had a lot of extra bodies and heads in the company, which I think was impacting our profitability below cost of goods sold. And so,
and then they weren't paying. They weren't paying either.
Yeah, and they weren't paying. So, I think having that new arrangement is much better. It drops our revenues. The other piece of revenue thing that I'm trying to get my head wrapped around. I really wish they would put their operating CFO both cumulative and per breakout each one. But software and data licenses for 3 months was 10.3 million, and sorry, in Q2 was 10.3. Technology and managed services was 17.8, and then settlement services 1.7. So from Q1 revenues, the software and data licenses went from 6.6 to 10.3. That is fantastic. That's also likely much higher revenue or gross margin business. But the technology and managed services moved from Q1 19.8 down to 17.864. And I'm trying to, and that's, I think the third or fourth or fifth in a row where it's sort of dropped. So one of the reasons where you lose this business information is that, are they cannibalizing some of the technology and managed services into the software and data licenses? And are you getting better margins? So if they cannibalize, the technology and managed services into the software, and for every $1 million of technology and managed services, you get 700,000 of software and data, but the margin goes from 40 to 80. Well, I'll do that. That's a great move. But there's still a lot of issues like where different areas are, we're still just not able to see some of this information. It's nice to see that collectively the the total revenues have moved up from 28,743 to 29,877. That is very good. But some of these things I'd like to see. Why is the technology and managed services still going down? Why is settlement services still going down? Now, settlement services is obviously driven by transactions in the marketplace. Technology and managed services, different. We don't get to see the sensitivity of certain things. Settlement services, but some of these other areas, I think they have different sensitivities to different movements in the market, and so that would be nicer to see. I think simplistically, it's good to see that change from the JEA modeling is starting to show legs. Obviously, it cut the top line revenue, but the gross profit is obviously getting better. It looks like some of the focused movement of some of the body count that has left Voxtur and moved maybe back over to JEA, and plus the culling of maybe some fat that wasn't needed. It seems to be having some benefit, but the way they report some of these things is still problematic. I'll give them a pass in that losing their auditor, changing auditors, getting the new processes. That may be, getting it to be accurate is first and foremost. Making it easier to read and breaking things out and giving more business information is secondary. But I think it's important, and I think it'll help investors get a better understanding of what the overall impacts of different market dynamics are having on the company and where is it having it. But I will say, writ large, seeing gross profits expand, seeing CFO from operations go from -9 to -2 is excellent. I think EBITDA, unfortunately, is mostly too much. There's too much noise in it. I think it's a meaningless number at this point. They need to either break out that section that gives you all these, the grab bag of different pieces, break that out, get rid of it, or do something that helps us understand it. But at this point, I'm sort of throwing in the towel a little bit on EBITDA. CFO is CFO. Comprehensive loss, I think, would be materially better. I mean, I still think it's actually quite good. You know, taking out $7 million, so comprehensive loss drops by almost $8 million, i.e. go to the better, i.e. comprehensive loss is less, would be a great thing to showcase. If they could do so, and I mean I know they can do so, but it just means that they have to move from reporting in Canadian currency to reporting in U.S. currency. I think it makes a ton of sense to do that, but you know that moves comprehensive loss closer to, you know, so you know, when you look at the comprehensive loss, change in tax recovery, that's a noise you're just not going to be able to deal with. Increase in human resources, that's a permanent element or semi-permanent element. Increase in finance expenses, that's a semi-permanent element. Some of the other ones are really not all that important, but $7 million of a 12, like almost 13 million. I mean, that's over 50%. So if you get comprehensive loss closer to, call it $5-6 million, and a change in tax recovery of call it 2.7. I mean, you've got almost like almost $10 million. So now you're down to 2-point-something million dollars, and that means that comprehensive loss is staying fairly steady. And then that, to me, that starts to show that comprehensive loss, your CFO, those are starting to become meaningful numbers, and you get a better understanding of where things are. So writ large, I think this is much better. At least we didn't have any major headlines of, you know, massive write-downs. But I think that we are starting to see, I think, a bottoming of some of the business units. I think we're starting to see through the actions of the company that the controls of the business are better. Being, what are we, 10 days early, 7, 8 days early? I don't know the exact number, but call it 7, 8 days early, is great. That's a huge win for this company. You know, and I think that there are some questions that, you know, and I'll likely ask a few of them. But, you know, there are definite signs of improvement. And I think the next move for them, now that it seems like they've at least got reasonable controls in terms of getting out this documentation, looks like they've dealt with a number of their big bugbears in terms of, you know, the old contracts and internal cost controls. And my suspicion is that cost controls are going to increase. Getting some additional adoption of some of their different business units will start to likely gain more traction. All of these things, in my opinion, will start to drive more revenue, but some of these things need to be dealt with. And obviously, the last one is that as of the time of this filing, the debt was still, the covenant was still blown, and they weren't on the right side of the covenant. They really need to figure that out and give some clarity. And if they say on the phone, oh, well, that one's now been cured, I don't know why they can't announce that in a more meaningful way. And maybe it has been cured by the raise of the additional $7 million. But it would be, you know, that perpetual footsie with the covenants is I think a going concern, which causes people issues and creates undue noise. So, you know, my hope is they convert to a U.S. Reporting. There's zero reason, if 90% of your company is now U.S. denominated, for you to add this, you know, like, I mean, that's $7 million on an increase of loss of 10.476. I mean, that's 70% for round numbers, and it makes no sense. So, but you know, seeing the gross margins go up, I'd like to get a better understanding, you know, above the line and below the line, and you know, to understand where they're doing some of the costing. And And so what's really in the cost of goods sold? I don't think with an MNP and with a Robin Dyson as a CFO that there's really any gamesmanship there, but it would be nice just to get better understanding of that. But so gross profits up, great. Revenue starting to trend back in the right direction, great. Noise from the I think EBITDA is doing too much heavy lifting when you've got $4 million in the other things. I think that's not great. Earnings is earnings, and it should be before interest, taxes, depreciation, amortization, not kitchen sink other things. And having to constantly dig out CFO by having to go to the Q1 numbers and then dig out Q2 numbers is just a unnecessary level of extra work. And if they reported in USD, comprehensive loss would look very similar to cash flow from operations, which is a good thing. And we would get, I think, a much clearer and less noise on these financials. I don't know if you can do it mid-year. I don't know the mechanics of that, but that would be one of the right things. So generally, I'm happy. Good to see that there are revenues coming still back from the JEA. Good to see that you can go into that area in the balance in the financials and actually get an understanding of what are the revenues and what are the costs, and and that's it. And there's no growing related party costs. There's no growing anything. You can also see Blue Water, by the way, in there. You can see sorry, not Blue Water, but the Rice Park revenues coming from that, and the fact that it's up to date and current. You see it happening. So I think I actually really like that part of the financial document. But they need to make this so people don't have to get into a Kama Sutra pose in order to read this thing.
Yeah, makes sense. Thank you for sharing your thoughts. Anything else you would like to share?
No, I just think in general this is actually quite a good print, and I think it's good to see that they're doing the hard work. Some of it's not pretty, but I think they're doing the hard work and they're moving in the right direction. And I'm looking forward to finally seeing Q3, hopefully 15 days before the reporting.
All right, cool. Thank you for doing this.
All right, thanks, Mariusz. Talk soon.